This is Bible School Radio, KDKR, Decatur, Dallas, Fort Worth, KYJC, Commerce, and KMWC, Bethany. On the web at kdkr.org and on all your devices with the Live 365 app. Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, the Fed has reduced the key interest rate. Now, what about mortgage rates? Today, we're going to take a look. Stay tuned for Prudent Money. Good afternoon, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, the Fed has spoken, and 0.5% interest rate cut happened. Now, what about mortgage rates? Mortgage consultant Mark Pfeiffer, as he is every month, comes on the program to talk a little bit about what's going on in a very important part of everybody's life who's in the real estate market, and that's mortgage rates. Mark, great to have you on the program.
As always, Mr. Bob, thanks for having me.
So if this doesn't get any more confusing, let's dig in and see if we can confuse everybody. Okay, so
challenge accepted.
I mean, it's really you have to work at it, but once you kind of see the connection of everything, it starts to make sense. So let's talk about this and as generically as possible, you can put this into layman's terms. Let's connect the dots. The Federal Reserve Board adjusts interest rates, cuts interest rate a certain percent, 0.5%, and then there's the 10-year Treasury bond yield that should be going down, but it's going up. And then what's mortgage rates doing now? You would think.
That's a good question. That's a good question, Bob. So what's funny is they often move together.
Yes.
And they correlate, but they're not necessarily directly dependent on each other. So what's interesting is the phones, as you would expect. We talk about this often, right? Over the many years we've been doing this. The Fed cuts rates. You see it in the headlines. You see it scrolling across the ticker. You know, you hear about it around the water cooler about the Fed cutting rates. To be very clear, the Fed cuts what's called the Fed funds rate, and that does impact a lot of borrowing cost. It does not directly impact your, I'm going to use air quotes here, normal mortgages. It does impact some mortgages, and that's where a lot of the confusion comes into play. Things that are line of credits, like a home equity line of credit, that is tied to something that the Fed then directly impacts. So it is confusing, but I would tell you as a whole, when the Fed typically lowers rates, they're doing so to help the economy because they only have two mandates, and that's unemployment to keep a healthy economy in terms of jobs, and then to control inflation. So because inflation has come down considerably, it was, call it 8 or 9%, depending on which one you want to measure, a year and a half ago, and it's now around that mid-2s, give or take. They have the ability now to cut rates so that the job market hopefully stays relatively strong. It's been, unemployment's been ticking up, but they cut that because things are not going well. So why does that influence our rates? Well, mortgages, the way you think about it is it comes to where would you invest your money? So if the Fed's suddenly going to cut their rates, well, then money may flow over to mortgage-backed securities, and more bigger investors want to buy mortgages, and that helps us drive rates down. So as far as keeping it easy, it is very complex, but that's the best I can say is that while the Fed doesn't directly influence it, a lot of times what they do is what long-term mortgage rates will eventually do. But we have seen a nice improvement in the last couple weeks, months, because of the Fed's anticipated rate cut. So that is the good news, and they're expected to cut more. We do think rates can and will eventually go lower than they are today.
Okay, so let me take the opposite side and ask this question. What would have to happen to really concern you? So what would have to happen that next month we're talking about, I didn't see that coming. I mean, is there anything, or do you think this is just a very normal thing that's happening?
Well, it's interesting. So I literally had 18 of my buddies guys and girls, loan officers that I've known for a long, long time. There are a few new faces, but 18 of us got together last week and asked that very question to each other. So these are guys and gals that have been in the mortgage business for 15, 20 years like myself, and getting together to say, man, are rates going down? Do we expect that? And with all things that we know at this time on the table, the job market's getting a little weaker, inflation seems to be under check, it makes sense that the Fed is able to cut rates. To answer your question, what could happen? Well, there were some dissenters. In the room of 18, 2 people thought rates could actually maybe go higher in the next. The time frame changes, right? So whether it's 6 months, 12 months.
Sure.
Because overall, if the Fed makes borrowing easier, cheaper, not necessarily easier, but cheaper, and more people, more companies, the government, right? Pick whoever you want to win the election. If the government starts spending more and more money, inflation could come back. If more spending starts happening because things get less expensive to borrow, and if inflation comes back, the Fed no longer is going to cut, it may go back to increasing rates. So it's a delicate balancing act. To me, that seems the most obvious in terms of if spending picks up because they cut too aggressive. But it could be World War III, who knows, right? Like, we read the headlines every day, so there's certainly the possibility of a black swan event. I just don't know where it'd come from, and that's the definition of what makes it a black swan. We just don't know where it's coming from.
Yeah, it almost, and this kind of leads into my next question, but I would think just from everything I've read and talking to you through the years that maybe it's really important what the expectation level is of buyers and sellers of real estate. So to me, I think and if you could give some color to this as far as what kind of percentage of people you think that this fits. But I think that there's a segment of people that are expecting this just to go all the way back down. And I think that that's a little unrealistic. But to me, what makes more sense is there's got to be, and maybe we're just coming up to the point where we're kind of developing this idea of what does this bracket look like that maybe mortgage rates are going to bounce in between. If you had, and I don't want to put you on the spot, and if you don't have a good answer for this, so be it. What do you think that bracket looks like today, knowing full well it could change? But once again, when I say bracket, I mean the mortgage rates kind of go back and forth between 2 points.
Yeah, good question. We, again, asked that with a group. So at least, unlike normal shows where it is my personal opinion, I'm giving now a mix of 18 different professionals in the Metroplex. So I will say this, but for starters, historically, like if you look back, zoom out for mortgage rates for, since the 1800s or whenever they started tracking, right, whatever it is, the cost of borrowing is usually between 6 and 8%. So rates historically, now don't get me wrong, there's certainly been that time period where folks bought houses with 18% interest rates and they're happy to get it, right? We all know those stories. But the reality is a normalized type bracket or range is at between 6 and 8. And we're there. Like FreddieMac.com shows rates now at like low 6s, 6.09, whatever it is. And that does typically have, close to a point on it. But it's low 6s for sure. It's high 5s depending on what you want to do and how you want to structure it. So that's kind of where we are today. So to answer your question, how low can you go? Right? That was the question, again, posed to a group of us. My personal opinion, which seemed to be the consensus, was they can go lower, but we did a range, like raise your hand if. And I would say over the next 12 to 18 months, most of us had rates around the mid 5s, mid to high 5s is kind of where that how low can you go without some massive big reasoning to go lower. Like it's not going to go back to the 3s and 4s. Global pandemic is what got us there. I don't think that's coming around the corner anytime soon. So I do think the answer is, my personal professional opinion is going to be that we get rates back to the mid 5s, give or take. Now, could it dip to low 5s? Maybe. I'd be very surprised to see a 4 point something, but there were 2 or 3 folks in the room that thought maybe the 4s would show back up. As I mentioned, 2 or 3 folks thought maybe rates would stay the same or go up. But the majority, myself included, thought that mid 5 range. And here's one other thing to think about. You mentioned the 10-year Treasury at the start of the program. Historically, there's usually I call it around an average of about a 2-point spread between the treasuries, the 10-year treasury, and interest rates, mortgage interest rates long term. And so if you figure we're at about a 3.4, 3.5, 3.6, somewhere in that range on these treasuries right now, mid threes, that means in a, quote, normal market, you'd see rates around mid fives. So that's another reason why I do think rates can and will be coming down over the next 6, 12, 18 months. But that's just what we know now. Certainly subject to change based on data and where the economy goes from between here and then.
So here's the question for you. What if, I mean, at some point it'll happen because it's all cyclical, but what if in the next 5 or 6 months we hit the actual true definition, you can't dodge it, it's here, of a recession? Historically, what has happened to mortgage rates and demand? I mean, do people go, well, that's great that mortgage rates are coming down, but I'm not motivated to go out and buy a house because I don't want to lose my job. Except what if I lose my job or something like that? I mean, do you actually, at what point do you kind of see a pickup in activity because the mortgage rates trump the idea of a recession or the reality of a recession?
Yeah, that's a great question. I'm gonna turn that into 2 questions, so answer it 2 different ways. So initial question is, if recession, if when, and I think when, we're already essentially in one, right? I think again we're here where things are tough. I know too many people in my personal circle, both work, professional and personal, where they're financially hurting. Some have lost jobs, some have been pay cuts, some are just struggling, just self-employed. So there's too many people that I know that as a macro, again, I realize it's only a few people, right? But in my little world, but as a microcosm, I just think the macro has got to be reflective of that. So I do think we're here. So the good news for the mortgage world and for homeowners is that recessions will lead to lower mortgage rates. So when things don't do well, it typically makes the cost of borrowing cheaper in the mortgage world. Again, without getting into why that is, it's just that's the reality. So that helps because if you still are employed, then you can refinance and save money. So it helps the mortgage world, certainly, because as rates go down, we can turn all these what were 7 and 8% mortgages now into a 6 or a 5 something, and people can save money. So rates will come down with recessions. It's a fact, right? There might be a few outliers here and there, and it's not all the time. It's not the second you're in when they come down immediately. But overall, that's a good rule of thumb. So what's interesting about the home buying market, the second part, and I'm turning your one question into 2, is the question was then posed to the group, what happens to home prices? Like, they're ridiculous. We all agree that they've had a crazy, crazy run-up, but none of us see that stopping, especially here in North Texas. There's too many people that move into North Texas every single freaking day. It's a lot. And the reality is home builders just can't build fast enough to keep up with demand, whether that's multifamily or single family. And so we're not sure what's going to make that stop, because when rates go down, Bob, you know this, more people can afford and more people come back from the sidelines to be back in the game. And if more and more people want to buy houses, it just drives demand up. And it's not like more people will sell just because if you don't have a job, you're not going to sell your home unless you absolutely have to. So it's interesting to see what is going to happen to supply and demand from the housing market perspective, because again, as soon as rates drop, millions, literally millions of people will come back online to be able to afford what they want to buy, and that's going to drive prices back up. So I don't know from a housing perspective what's going to change. I think ultimately there can and maybe something, but I don't know what it is, and I don't see that in the near future. The next 3 to, call it 3 years, give or take. I just don't see that happening.
So what, as you talk through all this, I sit here and think to myself, put myself in your shoes and say, what would I tell a potential buyer if with all this? And what comes to me, and you tell me if you agree with this or not, but what comes to me is if you found the house of your dreams and you can make the current interest rate work, do the deal versus trying to time something that may just about be impossible to time.
Exactly. And again, guys, yes, exactly what you just said, but I'll echo that and even share a story. I was with a buddy this weekend, and we haven't seen each other in a while. We were catching up, and how's the house? We helped him with the mortgage and all that stuff, and he bought it 7 years ago, give or take, 7 or 8 years. And at that time, the market was super hot, air quotes, super hot, and it was. And I go, and I made him. Like, it's one of those, like, as a buddy, he took probably 2 years to buy the house. I was like, buddy, come on. Self-employed, was doing well, year over year, making more and more money. And I didn't try to stretch him. That's not what we do. But he was worried, like everybody is, right? I've been worried every time I buy a new house. I hyperventilate at the new payment. But the reality is, 7 years later, his house has doubled in value. And so I'm like, aren't you happy? I was part of that cheerleading, on the sideline. It says, go buy it, go buy it, go buy it. He's like, it's one of the best things I did. So my point to what you just said, Bob, yes, the housing market's expensive. It's crazy. Now, whether you're an investor versus somebody looking for a home are two different things, right? And so my point is, to your point, there's going to be life events, whether rates are at 18% or whether they're at 3%, people are always going to have reasons to buy them, right? When somebody graduates from school, they get married, they have babies, they have twins, they have their sixth kid, they get a job change, they get relocated, they get divorced, somebody dies. Like, there's just life happens that makes people need to buy and sell real estate. And I would just say that if it's the right time, if you want a home, again, yes, you could argue the rate, the prices can come down, and that may be true for the first-time home buyer. But if you already own a home, who cares? Because if the prices come down, good for you. It's a great opportunity to buy, but guess what? Your current home goes down in value. But you've made so much as a current homeowner. The first-time home buyers are the ones that I always say, at some point, you got to buy at some point to get in the game, because paying rent for, it's 100% interest rate on rent. You get nothing from it, nothing to show for it. So at some point, buy when you are stable and you know what you can do, what you can afford. Market be darned. It'll ultimately, long-term, real estate's a good buy in the United States.
Okay, so let's say that off the top of your head, I'm sure you got the numbers there. You buy at 6, or you buy at 5. What's that 1% spread end up looking like?
Yeah, it can be on average. I would say it's about, and again, it depends on the rate and all that stuff. But say it's about a 1% interest rate. It's about a $50,000-$60,000 like purchasing price difference. So the point is, where somebody may say, well, gosh, Mark, you've been saying rates are coming down. I'll wait till next year because that'll give me $50,000 more purchasing power, right? Because it depends on the price point of the home, all that stuff. Well, the counter argument to that, and I'm not saying I'm right, but the point I make to the folks is, look, if you buy today with rates being where they're at, I understand you can get more house next year, but guess what? Today's $500,000 home could be $525,000 next year. Right, in Dallas-Fort Worth, and it depends on the pocket and whatever it is. So it's like if prices continue to go up, even at a modest pace, like you're still going to pay more for the home next year. And it could be even more than that, because then if the frenzy comes back where more and more people are going after the same home, the appreciation could be back in the double digits. And all of a sudden, you've negated it. Now you're paying you're more for the home versus you buy today, and you get to actually be the owner of that appreciation a year from now. So to answer your question, rates drop. Yes, you can buy an extra $30,000, $50,000, or you can afford an extra $30,000, $50,000. The question that none of us can answer is, what is demand going to look like when rates do come down, and does that demand push prices up the 30 to 50 to where it's a net zero waiting? And when you could have been the homeowner that got the 30 or 50 grand appreciation over that time period.
I don't know. I think that finding the home of your dreams, which is a harder to come by process than getting interest rates right. Because
I tell folks it'll feel right. It'll feel right. It's as much as you want to put the logic and the rates and it'll feel right when it's the right home and it's your home. Again, it's hard to find what makes all your check boxes. And I'm not saying there's a perfect home. Sometimes there is. Sometimes there isn't. Your perfect dream house may be still 5 years away, and you buy something now to get into it, knowing that in 3 to 5 years you sell it and go get the dream house then. It just depends. But I think it's more of an emotion. When it feels right and all the boxes make sense, you certainly got to do the logic part first as an exercise. But I think, and I know it cut you off, but I think it's just more of when it makes sense to buy a home, to live in it as your home, the numbers don't quite mean as much versus if you're an investor trying to actually do this, whether it's for a living or to make a profit. There's a lot more analytics that need to go into that versus finding the right home that just meets the needs of you and your family.
Yeah, I would add one other checkbox on there that the extra interest and the extra mortgage rate that you're having to pay for doesn't change your financial situation. That's also obviously a very big part of it. You want to make sure it doesn't put you in a situation where money is really tight and you got a problem and you're always trying to figure out how to pay the bills. That's and
totally.
you probably
that's where
see
you
people
buy right, and that's why I say that dream house may be 5 years out. Like what you want today may not be what you can afford, but you can't just sit around and rent for 5 years. At least, no, okay, I shouldn't use in my opinion, and I think the numbers would support a lot of times, that if you were to buy something today that isn't quite the dream house, but you then get the appreciation, the tax write-offs, and build up the equity through payments, all those things can make it so that in 5 years you will have a nest egg built up. The average homeowner has a 40x higher net worth than your renter. So 40 times net worth. And anybody that's owned a home in the last 4 or 5 years in Dallas-Fort Worth has just been like giddy. You know, sick when you got to go buy. But right now as a homeowner, if you bought in 2020, man alive, you're doing great right now from an equity position. So if you hadn't bought because you're waiting for that 5 years to get that perfect home, you may have missed a boat. That perfect home now is significantly more than it was 5 years ago. That's my only point to say. Like it's more than just numbers to buy a home. It may not be in the order you want. There may be a stepping stone, but I think that's so important to understand that the dream home, sometimes you don't need to wait for it. You need to get at least a plan of action to get to the dream home.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Mortgage consultant Mark Pfeiffer is here with me today, as he is every month. He stops on by, and we talk a little bit about mortgages and mortgage rates. So if you want more information about Mark, you go to mortagemark.com. That's still the website, right?
Has been, always will be, my man. It's too good.
Just making sure. Okay, so let's talk about as we wrap things up. Let's talk about the buyer, the homeowner that's sitting there with that beautiful 3.5% interest rate. How many people have you run into that? That's a tough one. I mean, you're gonna go out and buy, and of course, if you refinance, I mean, when you buy another home, you're gonna get a much higher interest rate than that once in a lifetime 3.5%. How do you consult with people on that?
Yeah, so regarding refinancing, like if somebody's listening to this and they're like, man, I got a 3.5%, should I refi? The generic answer is obviously no, right? But there are reasons to refi. If you're a 3.5 rate and you got a boatload of credit card debt, or there's some sort of business thing that's going on, if you're self-employed and you need the money or paying, we've seen people take money out to pay off the IRS or to take money to then reinvest in their business and go make a bigger multiple. That makes sense, but for the most part, you're sitting on that 3.5 until you sell, right? Unless there's a need-based refi getting in the way, there's no reason, obviously, to refinance a 3.5 into a higher rate, unless, again, there's a need-based reason to do it. And that's what they've called, and I don't know who came up with, the media calls it the lock-in effect. And that's part of the reason why housing inventory is still relatively low compared to, historically normal times, because people don't want to sell that 3.5, because not only do they go to a higher rate, homes have gotten so much more expensive, you have to pay a lot more for the same home. So it is that lock-in effect. And so my 2 cents has been, will continue to be, until there's a need for people to sell, and the need-based selling, right, it's what we talked about. It's family size increase, job reload, divorce, death, like life events will cause it to where these 3.5 rates that are, locked in will eventually have to be sold. And once it's sold, it's a lot easier to trade into 6% for another 6%.
Hey, Mark, we got to wrap it up right here. So listen, thank you for coming on the program. MortageMark.com is where you go. And if you got a question for me, please go to the website, prudentmoney.com, and send it in, because we are all out of time. Till we do meet again next time, keep the faith. Have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.